In this video, I will show you a simplified approach to finding high probability entries. And these kind of setups form every single day and you can use them right away. You can start today. So as you can see, I've made a 5-step plan that you can easily apply. And to be honest, normally I only taught this to people in my video course. So I used to sell a premium video course where I taught these kind of concepts and 5-step systems. However, I don't sell a video course anymore, so I decided to share all of that knowledge for free on YouTube. So here it is, here's the video. And obviously in this video, I will explain to you how to apply it, how to use this 5-step system, because this will work. It simply works, okay? I've seen this work for myself, for multiple people. So if you apply it correctly and you are familiar with the terminologies that I use, and I will briefly explain them in this video as well. If you're not familiar with liquidity, for example, break of structures, fair value gaps, you can watch my separate videos about those things, because then I will go more into detail about what they mean, what they are, and how you can apply them. This video will be more of an overall strategy that you can apply. And by the way, if you're new to the channel, my name is Alan and I'm a trader myself and I help people to become profitable traders. So I do this by making these kind of videos, but I also have a profitability program. If you want to know more about it, watch till the end of the video. So let's begin with the 5-step system, because this can literally make you profitable if you're not profitable yet. So let's start with the first step. The first step is identify liquidity. Now I've made a simple drawing here. First I will explain it here, and then I will show you some real examples. So liquidity is basically the place where a lot of stop losses are. So the simplest way to see where liquidity is to think, okay, where would people place their stop loss? So let's say you have this low. When there is a clear defined low, there is always liquidity below that low. And it has to be very clear defined. Like, it cannot be messy like this. No, it needs to be a pivotal point that creates a clear defined low. And there is where most people place their stop loss. So most people place their trades like this. This is their entry. And they place their stop loss right below that specific low. That's why you know that a lot of stop losses are stacked up under this low. And other examples of liquidity are support and resistance liquidity. So where people that use support and resistance place their stop loss, or trend line liquidity where they place their stop loss. And you can notice multiple ways of liquidity being formed. And I also made a video about liquidity, so you can watch it to go more into detail. But you need to understand that liquidity is what ultimately moves price. Price doesn't move by just some selling and buying pressure. It moves by liquidity, because the banks and the institutions are really pushing the price. And they need the liquidity to fill their orders. So where you are stopped out as a retail trader, that's where the banks are filled in their entry. So instead of having their stop loss here, they actually place their entry there. So they are having their entries where people get stopped out because they need that liquidity. So this is the first step. You find a liquidity point like this. So this could be a low or a high. Then step 2 is wait for the liquidity to be taken out. So now we can see that liquidity has been taken out. Price moved through the liquidity. And you want to see a movement going all the way through the liquidity. So not a small movement like this, slightly touching it and then going up, because we see that as just a support level. It really has to go through the level, hit all of those stop losses, and then take off. That's how you know that it's a liquidity sweep, liquidity raid, however you want to call it. Liquidity has been taken out, the stop losses are taken out, and then the price has enough liquidity to actually move. So this was step 2. Step 3 is wait for a break of structure. And if you're not familiar with break of structure, let's say we are moving downwards, we are building lower lows and lower highs, then you want to see a shift in the market structure. So you want to see a higher high being created, because then you shift your downward structure of lower lows and lower highs into creating a higher high, and then a higher low, another higher high. This is a break of structure. You're breaking the current structure. So in this example, you see that price was going down. You were creating a lower low and a lower high here. Then you suddenly move across the high. So you break this high, you break this structure, and this is exactly what you're looking for. Breaking a previous high or low, that's the break of structure. Then you have enough confirmation to look for an entry. Because we don't have certainties. But now if you see liquidity being taken out, you see a break of structure, it is likely that price will go up. Again, we have no certainties, but it is very likely that price will go up. And again, if it's going too fast or you don't quite understand these concepts, you can watch the separate videos because I won't be explaining them in detail in this video. Step 4 is find a fair value gap. And this will be our entry. A fair value gap or imbalance, as a lot of people call them as well, is the same thing. It's a space between candles. So when price moves very rapidly, you see that it creates these imbalances, these fair value gaps. And that's what price will be looking for. Because the algorithms used by banks and institutions are looking for these gaps. They want to fill up these kind of gaps. And that's why they work so well for entries. So when you had your break of structure within this movement, you are going to look for a fair value gap. And I will show you some examples in this video. The fair value gap is basically the space between your first and third candle. So we'll be looking for a fair value gap here to place our trade. And then step 5 is placing your trade with your stop loss and your take profit. And you need a risk reward of at least 2. So your risk reward has to be higher than 2 to 1. Okay, so let's look at an example, and you can use any time frame for this. I'm using the 5-minute time frame now because I'm mainly day trading, almost scalping. So I like to use the 5 minutes. You can go to the 15 minutes, the 1 hour, it really doesn't matter. If you like to be more of an intraday trader or a swing trader, you can obviously go to the higher time frames. And speaking about higher time frames, in this video we won't be covering things like the higher time frame bias or the daily bias. Those kind of things are important, but this is just a simplified strategy that you can apply because this just works. So this is a simplified version of the strategy. All of the more detailed things like where to find the liquidity, I will cover it in separate videos. So step 1 was find a liquidity point, and we found this low. And this is a clear defined low, as you can see. It's a wick pointing down. And it really stands out compared to the other lows here. Another example would be this high or this high. Those are highs and lows that I'm looking for because they are clear defined, they are pivotal points, and you can easily spot them. So the easier you can spot your high or low, the more liquidity is below or above that high or low. The reason why is because many people see this low. So many people are looking at this specific low, which is why there's a lot of liquidity below it, because that's what the retail traders are looking for. So step 2 is waiting for the liquidity to be taken out, and you can see that price went through your liquidity. So price went through the liquidity, took out all of those stop losses, and then moved upwards. Therefore, it also created a break of structure. If we take this high here, so you look at the local high, this local high was broken by this candle. So it created a break of structure as well here. The structure was going down something like this. And now it actually broke this high and is creating an upwards structure. So we have a break of structure and a liquidity rate. So you see liquidity being taken out and a break of structure. So again, we don't have certainties now, but now it's very likely that price will go up because it looked for those stop losses and it actually reversed the structure. So now the next step is looking for a fair value gap. And I see multiple fair value gaps. However, I want to go for the most defensive one. So that's this one. You can see that there is a space between this candle and this candle. So if you pick this as your first bullish candle, you can see this is your second candle and this is your third candle. And it's the space between the first and the third candle, which is called the fair value gap or imbalance. So this is what we'll use for our entry. And again, if you're not familiar with fair value gaps, you can watch my separate video about it because then I go more into detail. Okay, so now we found our fair value gap here. So you can either place your trade on top of the fair value gap, so your entry on top of the fair value gap, or you can place it more defensively at the bottom of the fair value gap here. And then it would actually be on this demand zone here. But you basically have the option to pick between the top of the fair value gap or the bottom of the fair value gap, depending on the specific setup and if you want to be more aggressive like this or more defensive like this. In this example, I want to be more aggressive. So let's place it here. And with your stop loss, you want to place it wide enough because most people place it immediately below this candle, but that's too narrow. You want to place it wider and cover more of the price action. So I see a lot of wicks here. I want to cover at least this low. I think this is a very clear defined low as well. So I want to be below this point. And then if you remember correctly, we need a risk reward of at least 2 to 1. So as you can see here, risk reward is 2. And you could be targeting a certain point, a certain liquidity point, like this high, for example, for your take profits. However, I'm just going to use a risk reward of 2 to keep it simple in this video. So now you place your limit order, this is your trade, and you just simply wait for your trade to be filled. And as you can see, it hit our entry and now we are in the trade. And there it is, it already hit the take profit. So as you can see, you took your profit here, you had a 2R profit, and then price went down again. So you had your take profit, you were in the trade, and it was very profitable. So here is another example on the 5 minutes again. And what I see is I see multiple lows, obviously. But what stands out to me is you could say this low being taken out. However, I see that there's a lot of lows here, and even if you go to the 1 minute, you can see it very clearly, is building a support level here. So you can see that price was supported by this level multiple times here, this zone. So this shows me that there's a whole support and resistance zone here, which has a lot of liquidity sitting below it. So I'm targeting this as my liquidity point. You see that price took out the liquidity with this movement. It took out all of those stop losses and then it moved up. And like we are doing in the next step, we see that there's a break of structure of this high. So if you look at this high, you can see that it was broken by this candle. So price is now creating this break of structure. So we have enough confirmation to look for a possible entry. And again, no certainties, but it's very likely at this point, with the liquidity being taken out and a break of structure, that price will go up. So what I see is, I see a fair value gap being created here. So this is your fair value gap being created by this rapid movement. And this is where we want to place our entry. So again, we can place it on top of the fair value gap or more defensively at the bottom of the fair value gap. I would like to be more aggressive in this specific setup, but you can decide it for yourself. Then I place my stop loss not here below the candle, but all the way down here below this whole low. You want to cover all of the recent price action here. And for our risk reward, let's target this high. So we are not just targeting 2 risk reward. No, we are looking at this liquidity sitting up here from this high. So then we get a 2.95 risk reward ratio. So let's take our profit at this point. Let's now place our limit order and see what would have happened. So if you had placed your limit order, you see that you were filled here. So it touched our entry. And then price takes off. And it hit our take profit perfectly. So as you can see, here you are into the trade. So this is where it fills your entry. And here's where it takes profit. So you had a very nice, almost 3R on your trade. So this is the 5-step plan again. And Don't believe anything I just said, just try it out for yourself because I know that this simply works. So try it out for yourself. You need to build experience using this. So you need to understand what liquidity is, how to find it, how to find your fair value gaps, where you need to take profit, for example. So this is a simplified 5-step plan, but obviously you can go more into detail about how to actually place a trade and manage the trade. And therefore you can watch my other videos as well to go more into detail. And really quick before we end the video, if you really struggle to get profitable, like I said in the beginning, I have a profitability program where you will become profitable within just a few months instead of years. So if you're interested in that, you can send me a DM on Instagram @AlanTheTrader, and then we'll see if you are eligible for the program. Thanks for watching the video and good luck with your trading.